Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. As soon as I get my microphone fixed. Hey, it's been a exciting Friday, huh? The markets go down over 2% a day. Actually, I was wondering when that was going to happen because it's been a long time. It's been over a year since something like that has happened. And that is highly unusual that you go that long without a correction. And it's highly unusual that you go that long with as low volatility as we've had. So, and if I'd have known exactly when that was going to happen, that strange sound you'd be hearing would be my flight of private jets flying over right now. I'd be waving down to everybody. You just can't prepare for that. Well, you can prepare for that, but you don't prepare for it by trying to anticipate it. That's a really good way to do very poorly in the long run. Got to get really lucky to do that. Having said that, we've got some information coming up later on today's show to talk about the time periods that the market tends to do the best. And so listen up for that because we'll be covering that in one of the later segments. And I'll offer to let anybody want to call in with any questions you have. The number is 216-901-0945. And I have with me in the studio again today, Director of Marketing for Bullington Capital, Melissa Arcuri. Melissa, thanks for coming back.
Thanks for having me on the show.
And I think we better get your microphone turned on. Try to talk one more time. Okay, so we need Melissa's microphone turned on. Try to get. Are you there?
Thanks for having me on the show.
Wow. So, all right. Just lost my train of thought. Oh, we got a seminar coming up, and I think it's going to be a good one. We're going to talk about momentum-based strategies. Those have been very unpopular with an awful lot of people lately because they've been out of favor, and the conditions for those types of strategies to come back into favor are actually improving. There aren't a lot of things that you can say about markets other than over time they do have a tendency to return to their averages. And when their averages when the average has been below average for a long period of time, it has a tendency to go back above average. And the more skeptical people are, the more likely it is to work, unfortunately. The reason I say unfortunately is because it's never comfortable. If you're comfortable investing, you are not doing something right, or you've been doing this for an incredibly long time period. One of the two. You're either very sophisticated or you're average. The super sophisticated have gotten comfortable being uncomfortable, so they don't even notice it anymore. It's like having a smell in your house that you grew up with. I'm just kidding. Yeah, but one of the reasons I want to bring Melissa in, Melissa's actually a certified yoga instructor, and has a ton of good information regarding how to calm yourself down, self-awareness. It's been very helpful over the past couple of years, being able to bring this in and actually indirectly. I don't know. We've talked about this before, but playing organized sports, particularly football or basketball, they're so strenuous physically that you do learn a lot of these things. They don't talk about them the same way that you do, but some of those things are learned along the way. And I think we were talking on the radio program about financial markets, people being confused and not knowing where to start, especially the younger people.
Yeah.
There's been a whole lot more information out there, and even that can cause stress, I think. And I don't know if you had any. In fact, let's just go into it. Whenever you feel really stressed, what kinds of exercises can you do, or what would you recommend?
Starting with the breath. It always comes back to the breath. So there's many breath exercises you can do. One that's really popular that even the military uses is called box breath or you can even do the 4x4 breath. So basically it's sitting down, centering yourself, taking a deep breath from your belly for about 4 counts, and then holding it, and then exhaling for 4 counts. So basically you inhale for 4 counts, retain your breath for 4 counts, exhale for 4 counts, retain your breath, and then you start all over. But I think one of the things that really helps is becoming aware. So before you're going into maybe a big meeting or sitting down to look at your finances or going into a stressful situation, you just want to become aware of your breath. So noticing, is it shallow? Is it coming from your chest? Are you taking deep belly breaths? Just noticing where the breath is and not judging it. And then maybe using one of those techniques that works best for you, maybe just starting with that, 4 count breath to really calm yourself, calm your nervous system down, and just get yourself mentally prepared in the right state of mind for whatever stressful situation you're about to encounter.
Right. Yeah, I think that's perfect. And I think especially when you have a day like yesterday, or, you had the Brexit come up. Brexit caused a brief drop in the markets. If you were just to slow down, do the 4 count breathing that you just talked about, and where can they find information on that?
Oh, you can Google it anywhere. Just, you can type in breathing techniques or box breathing, 4x4 breathing, anything like that. They call it pranayama in yoga. So just, coming back to the breath and doing the breath exercises. They have alternate nostril breathing. They have the bellows breath, the bee's breath. So there's tons of them out there. And it's just, trying different ones and seeing which one works best for you. But you can keep it as simple as just inhaling for 4 counts, retaining your breath for 4 counts, exhaling for 4 counts, and then retaining.
Yeah, I like the simple stuff.
Yeah, keep it simple.
So, and I know a lot of people probably think that this sounds kind of crazy, but I can tell you there would be a tremendous number of people who would benefit not only in your finances, but just your all-around health, your mental health. It helps just to slow down. Try not to think about anything for a little while. And that's what the focus on the breathing actually helps you do. You're focusing on your breathing, nothing else.
Mm-hmm.
And it clears up. It's amazing how something like that can help you.
Mm-hmm.
It's just absolutely mind-boggling what you can accomplish
Absolutely.
by doing something like that. And, I misspoke. The Brexit thing wasn't an entire year ago. It was about 9 months ago. So it's hard to believe that it's been that long.
Yeah, that went quick.
Yeah. Huh. But that's what happens when you're having fun. Time flies. But anyway, and right before that, last August, there was a really big drop. And we were talking about this too. This is a perfect time to start learning maybe the box breathing technique, the holding it for 4 counts, taking for 4 counts. Because September, historically, has the worst performance. The worst performance comes historically in September. A lot of people think it's October because in 1929, the market dropped 11% in one day. The super old timers remember that. The 1987, you had a big drop in October. That was a 20% one-day drop. It was twice the level of the drop right before the Great Depression. October has been associated with big crashes when actually September is the worst performing month. August is pretty close to that, by the way. August, September. So we got through August this year without a drop whatsoever, and now it looks like maybe we're correcting a little bit. Interestingly enough, the best month in the year over the past 100 years or so has actually been October. So despite the fact that people associate that or used to associate it much more so, I'd say today it's not as common. Today, people that are my age, mid-50s, early mid-50s, and older, they remember the 1987 incident fairly well because you're only out of college for a couple of years and you're working probably one of your first jobs. You didn't have a whole lot of money at that point in time, so you saw it, and you saw a whole lot of people being very upset, and you weren't really sure why they were upset. So anybody that's younger than I am doesn't remember any of that. My first foray into doing research on my own, because I really didn't like trusting other people for everything.
Mm-hmm.
I always kind of came from the Ronald Reagan school of thought, trust but verify.
Mm-hmm.
And so I went back and I looked at 1973 and 74 and saw how poorly the financial markets did. And I saw that the S&P 500 and the Dow Jones had a 13-year flat time period. Kind of like if you started in 2000 in March of 2000. Well, guess what? There's another more than a decade with negative returns. And that's what I wanted when I first started in the business. Went back to study. What did the people that actually ended up making money during that time period, what were they doing differently than all the others?
Mm-hmm.
And then when I found out what they were doing, I was going, wow, this is going to require a significant amount of mental discipline. You're going to have to be extremely disciplined not to end up where everybody else typically ends up. Mm-hmm. And one part of that was there are actually two different ways. There were some momentum guys, and there were some value-oriented guys. The value-oriented is always outnumbered the momentum. I'm pretty sure I know why that reason is, and we will be talking about that at the next upcoming workshop. Two really basic schools of thought when it comes to investing. You've got value-oriented investors, and you have momentum-based investors. Some people like to combine the two, momentum with value. So that's just a combination of the two. Mm-hmm. And then you've got, so those would be the opposite ends of the extremes. You've got deep value and pure momentum. And then you've got all these blends in the middle where people try to do a little bit of both. Some people do it successfully, some not. One of the ones that have been successful over time typically have done very well up until they get to a certain extent. When they get to a certain size, you're almost forced to become a value investor. And we'll talk about that why at that workshop. And I'm trying to remember when the workshop was supposed to be. I think it was the 22nd, actually.
It's the 6th.
Oh, the 6th. Is that October 6th?
Yeah.
Okay. So, yeah, October 6th. That's coming up relatively soon. By the way, if you tune in next week, we're going to get bumped. There's I think a sporting event or something that's coming up that they're going to broadcast. So this show is not going to be, we're not going to be doing this show next Saturday. I haven't decided yet whether I'll come in on Sunday at 6 o'clock. I might come in and do the 6 o'clock show, but on the sister station 1220. So if you're listening in next week, we're probably not going to be on the air Saturday morning 11 o'clock. In fact, I can tell you we won't be. But haven't decided yet whether I'll do the Sunday night show. But the seminar, getting back to what I was talking about, it's actually going to start at 6:30. There are two parts of it, actually. 6:30, we're going to talk about picking individual stocks. I've just written a little super short guide. I'm going to bring it with me. It's not completed yet, by the way, so don't ask for it. I'll bring it there. And it's 95% of what you need to know to pick stocks. Once you've seen this material and worked through it a few times, you should be pretty good. Yeah, it's really not as complicated as people make it out to be.
Mm-hmm. Keep it simple.
Yeah, I think you have to today, just because there's so much information out there. And that's another thing that you and I had talked about. There's so much information. Where do you begin? And where do you even start? And I guess the answer to that question really depends on what are you looking for. Mm-hmm. And by the way, the way that most people teach everything, the way that the general public teaches, is to try to teach you everything there is to know. Go into an Apple store to one of their classes. They are trying to teach you everything there is to know in one particular application, but they're trying to teach you everything.
Yeah, it's tough.
And I can tell you that I do a lot of stuff on computers and a lot of stuff that people look at it and go, wow, you must be a genius. Nope. I promise you, it's not true. Okay? I have learned to focus on what I need to know. Mm-hmm. That's not always that easy. Okay? Sometimes you end up learning things that you really didn't need to know. Okay? But all other things being equal, that's where you start. So if you're starting, what is it that you really want to know? What do you want to know about financial markets? Well, I want to know how to be successful. Okay. What area is it? Do you want to get better at budgeting? Because I think that's pretty easy, but it might be investing. Mm-hmm. And all this comes down, personal financial success comes down to budgeting and investing. That's really what it comes down to. Mm-hmm. Investing well doesn't work a whole lot if you're not putting a lot of money into it.
Right.
So you have to add money to be able to add money to it. You've got to have a budget, right? So those are probably the two most important things. Now the investing part of it, that is kind of what we're talking about at the workshop. I try to break these down into pieces because investing is huge. It's a vocation. Investing is a vocation, and I'm going to tell you right now, a financial planner who doesn't manage money might be good at doing the budgeting part. But without the investing part, you're going to suffer. Your returns are going to be significantly lower than they could be or should be. And you'll probably have about the same level of volatility that the other people that are doing things, making more money than you, are putting up with. So, again, where do you want to go? Do you want to learn how to be an investor? Okay, there are only a handful of asset classes that you can invest in. We're going to talk about one of them, which is stocks. And we're going to talk about one particular mode, which is momentum. And it's again, when you look at stocks, there are two basic modes: deep value, pure growth, just pure momentum. And then there are a bunch of shades in between. So if you want to learn all the ones in between, you learn the two on the ends. You learn the deep value and you learn the momentum. All the others will make sense to you then, because those are the two extremes. Everything else is a variation on those extremes. Now, I will say this. You'll have some people come in and give you explanations for things that make no sense to anybody. And they say them with such conviction. It makes you believe. And if they've had some success, I can tell you, typically it's because they got lucky. And they're making up reasons as to how they did it, why they did it, when they did it. And it's like somebody claiming they've learned how to crack the lottery. Okay. But anyway, here we're going to have to take a commercial break here in about 60 seconds. But I appreciate you coming on the show this morning and helping. It makes it a lot easier.
Yeah, thanks for having me out.
Yep. And again, that seminar, you can go to the website. It's bullingtoncapital.com. We're going to talk about momentum investing. I had Melissa put it up on the website as the other side of value. Again, what we're talking about is the extreme. I've got a new model I'm working on. Just got some information, and it's for emerging markets. Should not represent more than 10 to 15% of your portfolio because it is aggressive. This is aggressive with a capital A. Okay, so you shouldn't put a whole lot of your money in there, but I think it's interesting. It's fascinating. It'll give you some insight into what momentum investing actually is and whether or not it's for you. It might not be. In most cases, I would say probably not. But it's good to know that and be able to decide for yourself. So I hear the music. That means we have to take a real quick commercial break. Listen to Bill Bullington, Melissa Arcuri here on 1420 The Answer. We'll be back right after these messages. And we're back. So my marketing director pointed out that Brexit was actually only 3 months ago. I have to explain. I was looking at a chart of the S&P 500, and the correction that started back in the November of last year through January this year was what I was looking at because it was so much larger. That was a pretty big drop. That was fast and furious, actually. The month of October, again, was best performing month last year. From peak to trough, it was a 20% increase. That's pretty wild in a month.
Wow.
You know? Then it turns right around, gives it all back, goes down, ends up being one of the worst first quarters, worst Januaries in the history of the stock market. Wow. So that's what I was looking at. And the Brexit looks like a blip. It really looks like a blip compared to that. So, yeah, the Brexit was only a few months ago. And it was pretty short, pretty fast, furious. It was over. And now we're even with Friday's big drop, the market's still ahead of where it was before the Brexit began. So anyway, I got a question coming up here. I think it's a question. Let's see. Actually, this is Daryl. We're going to be how you doing, Daryl?
I'm terrific. Thank you. How are you?
Pretty good.
Nice to hear Melissa's voice.
Good morning.
Yeah.
How are you?
Good morning. Good morning. Yes, I'm doing much better than I deserve. Thank you.
Yeah. Her voice probably...
So I was thinking... Go ahead.
I said her voice probably paints a much better mental image than mine. I'm sure. But anyway, so what were you...
Especially if you know how good she looks.
Yeah. That's true, too.
So this market drop yesterday.
Yep.
You talked about discipline a little bit earlier and how important it is to be disciplined. And you've taught me that 95% of the stocks that are tradable out there generally are owned by institutions, run by big, fancy, high-paid professionals.
Right.
What is wrong with their discipline?
Well, actually, they don't have control over a lot of that. So they can't. Some of them, absolutely, they need to be blamed. A lot of them do a lot of things they shouldn't be doing. They will end up just like this one guy I talked to that works for Bloomberg now. The guy used to run a $3 billion fund. And the longer I've talked to him, the more I realize, they never should have put him in charge of that fund. And he's a nice guy. He's a really nice guy. But mentally, he just doesn't have it. And there's Peter Lynch talks about that. A lot of people talk about it. It's a mental state of mind that you have to achieve, and you've got to be in. That's why I had Melissa talking about breathing. It helps. And I can tell you throughout 2008, and 2009, I woke up every morning, and I meditated for at least 5 minutes, and my thought was, my mantra was, just breathe.
Just keep breathing.
Just breathe. Keep breathing. And you do that for 5-10 minutes, just breathe. Your body slows down, your heart rate slows down, your blood pressure starts to drop. That is a literal fact, by the way, because I used to take my heart rate and I could see it. It happens if you just do it. And you don't even have to believe that it works. If you do it for 30 days, it's going to work. But whether you believe it or not, it'll work. And you'll be able to measure it. So,
I believe it, and I practice it too.
That's good.
So, again, coming back to what happened yesterday, what is the mechanism? And I understand that the drop was based on the fact that they're stocks, and it's based on attitudes towards the stocks and not necessarily their true value. What causes the emotion to start to roller coaster like that, or I should say snowball as it rolls down the hill? Yeah. Why do people just keep buying into that, or not buying, or selling off?
Well, there are lots of computer programs, and the answer, by the way, is that you literally have tens of thousands of funds that are big enough to cause a move like that by themselves. So you've got to figure out which out of those thousands of funds is going to hit the button. And then you have to figure out the other funds that are going to be triggered by that fund. And a ton of them are computer algorithms. You hear about that stuff all the time. You hear about this guy, Renaissance Capital. They hold this guy out like he's a king. This guy has been front-running the market and has made himself a billionaire, and what he's doing technically should be illegal. And they hold him out like he's a genius and somebody to look up to. I would not want my kid doing that. It's not above the law. It's above the intent of the law. Technically, he's safe, but he's taking advantage of people, and he always has. And he's a multi-billionaire now, so he doesn't care anymore. But that should have been stopped before it got started. And the fact that he was so successful, and now you get a bunch of other firms doing the same thing, any one of which can cause that to happen. There are hundreds of those types of funds, and there are thousands of other funds.
You wonder why our socialist government officials don't go after a guy like that.
Because they're paying their salaries. Absolutely. They pay fines out the yin-yang, and it's cheaper to pay the fines and keep doing the business. Now, he's never been fined. He's been able to it's political. The bottom line is it's political. Read the book. Now I forgot. It was about high-frequency trading. Something boys. I can't remember what. My mind's going on me. Anyway, there was a guy that exposed a lot of this stuff, and everybody poo-pooed it. Oh, yeah, that doesn't really happen. No, it happens. It happens. I promise you, it happens. There are people that have you ever notice that when they show you pictures of Wall Street right now, there aren't a whole lot of people walking around? The reason there aren't a whole lot of people walking around is most of the buildings around there, a lot of the buildings, I should say, are filled with servers. Servers don't need people. They need one engineer to run this, a massive complex, or 3 or 4 at the most. Yeah, it's called Flash Boys, by the way. Thank you, Melissa. Melissa looked that up on her iPhone for me. So it's Flash Boys.
I was going to say, this thing that happened yesterday, what was the actual sequence of events? What triggered it? Something.
Well, see, here's the thing, though. You have to know which of those thousands of funds did it. Which one? You got to go find that, and then you have to ask them why they did that.
Wasn't there an incident in Europe with
Drago? There's something that the newspaper will claim caused it. It was supposed to thunderstorm this morning. Why didn't that happen? They can tell you after the fact, and typically that measuring the weather is much more accurate than measuring the tens of thousands. Think about this, tens of thousands. I'm trying to get this point through. It's tens of thousands of money managers that have the ability to do what happened yesterday by themselves. So you've got to know. By the time you take the poll and by the time you figure it out, it's not going to matter. It will have taken so much time that the market's in another direction anyway.
Yeah.
So, and you just can't know. And that's why it's so important to have a plan that gives up the notion of trying to know that kind of thing. You don't need to know that. That's not necessary. And that's a really difficult thing because the vast majority of people think that in order to make money that you have to know something like that. You don't. I'm living proof of that. And everybody that does the kinds of things I do is living proof that you do not need that. Warren Buffett couldn't give a crap that market went down 2%. He doesn't care. And he's not going to try to anticipate it either. That's not how he got to be one of the world's richest men. So you've got to come up with your own methods. They should fit your personality. It's very difficult because you have a ton of people. Go to one of the money shows sometime if you want to get sick to your stomach, because you're going to walk through there, and there are these guys that are telling you that, yes, they could have predicted that. And then they show you in the past how they've predicted everything in the past. And in fact, the last money show I was at, this guy had to pay $150,000 for the booth space that he had. $150,000 for booth space. Okay. And he's telling everybody that he can predict those moves like that. Well, the market dropped 5% on the day. I walked up to this guy. Hey, did you see that? And you should have seen how mad he got. Because there was a whole bunch of people standing in line. Did you expect that? You were short the S&P yesterday, right? I'm telling you, it just, not only can it not be done, it doesn't need to be done. You don't need to do that. What you do really need to do, you've got to come up with a strategy. You got to become familiar with it. Like the high dividend model, probably one of the more popular. And now that I've been with it for a much longer time period, I can see why. Because it does bounce back fast. The next time momentum kicks in, and it will kick in again, it's not dead. That's the way all these things work. They'll stop working long enough for you to give up hope on them, and then the minute you quit, it starts working again. And that's part of the stock market. And that's the thing that the financial planners don't know. They don't study this hard enough to learn that kind of thing. They're studying budgeting. They're studying taxes. They're studying estate taxes. They're studying Medicare, Medicaid, all that stuff. And that's great. You need people for that. But if you really want to do well at investing, it's a vocation. And it's very difficult because of all the things that you just have brought to light. You have to learn how to deal with those things. You have to give up the hope of knowing in advance what's going to happen. You can only use probabilities. That's all you're ever left with is probability, which is fine. That's what Vegas runs on, probabilities. They do not win every hand. If they did, no one would ever go there. It would still be a spot in the desert someplace. But they know over a long series of events that the probabilities favor them, and by the size of the light bill they must have, they're right. They couldn't pay those light bills if they weren't making money. So they make a lot of money out there. It's probabilities. Just put the probabilities in your favor. And I know. Hey, we got to plug your Nutriskin.
Yeah, I was going to say, Speaking of making money,
Yeah.
yeah, we've got an opportunity for people to have a small home-based business with no home parties, no large financial risk, lots of free training, and the training is fun. It doesn't hurt to go through the training, and of course there's a very small financial risk.
Right.
It's hardly any financial
Especially
risk
to go
whatsoever.
into a business. Yeah. Yeah. Starting a business is
so
typically really expensive, but
yeah.
this one not so much.
And our supplier has been in business for 60 years, so they know what they're doing.
Yeah, yeah, absolutely.
The products are, yeah.
So it's Nutriskis.com. And you,
Nutriskis.com.
All right. And if anybody listening forgets that, just email me and I'll email you a link to it.
I appreciate that, Bill. And I have one other question if I have time.
Sure.
What's your take on the Wells Fargo setting up phony accounts? What are they doing?
Oh, we'll have to talk about that maybe on a next Sunday show. That's a long one. Yeah, it wasn't good. It wasn't good. It was guys trying to make a living in taking shortcuts. That's what it was.
So was that the management that pushed that, or was that
no,
the individual?
The management set up the compensation structure that caused the salespeople to take advantage of it.
Okay.
Yeah.
I get it. Well, nice chatting with you and with Melissa. You guys have a great weekend. And,
You too.
Talk to you very soon.
Okay.
Take care.
Thanks for calling. I got about 3 minutes, so I'm going to try to get to Jerry really quickly. Hey, Jerry, how you doing?
Good afternoon or good morning, William. I'd like to put a little more money into my investment portfolio.
Okay.
Okay. I got two stocks. One that is said is going to put itself up for sale. The other one is rumored to have.
Okay.
One we've talked about before is called Qualis. The other one is Infoblox. Both are selling at their annual high. Both have volume like they haven't seen in some time. And the point I'm coming at now, I've made money on them, but I don't want to lose any. Well, how's the best way to maximize my return on investment? By selling covered calls, trailing stops, or
I would probably both of these stocks. By the way, if the deal falls through, those stocks are going to drop like a lot.
Well, one is rumored to have. The other one is said it's putting itself up for sale. So
yeah,
nothing's happened yet.
Right.
However,
that can take years. Neither one of those stocks are super cheap. By super cheap, I mean they're not selling below their liquidation value.
Right.
They're selling for actually multiples of their liquidation value. So there's some risk there. That's a tough one, Jerry. That is really tough. If a deal goes through, somebody wanted them badly enough, they might be willing to pay a premium over what they're currently selling for. If they can't find a buyer, then share prices could drift back much lower, which they have been in the past.
Yeah.
So
in a scenario like that, the arbitrator, say if they've already said we're putting ourselves up for sale, what's the maximum? I realize they're only stocks, but the maximum is perhaps another 20%. Do you think is that?
It's too hard to know. It's too hard to know.
Is.
Yeah, you just don't know who wants them. They have some technology that would be an integral piece to someone else's technology that could advance them further, where you get a synergy and 1 + 1 = more than 2. You just have no idea. I mean, you're basically shooting in the dark here and hoping that you hit something. So if you've got big profits on it, you might sell deep in the money calls. You won't get a whole lot of premium for it, but if it drops back, you're not going to lose much money either.
Now, deep in the money call means, say, for example, if a stock's at 40, I sell calls at 35. Is that what you're saying?
At 30.
At 30, okay.
Yeah. Yep.
25% below. Okay, I'll check that out.
Yep. You'll get a little bit of time premium for it, so you might want to go out over 9 months or so, give yourself a little bit more time. That'll give you a little bit more premium, but it gives you a lot of downside protection, because if that stock drops back to that lower price, you're still good.
Yeah.
So
okay.
you're getting a little bit of premium. You'll get to keep the dividends if they're paying them.
No, they aren't.
Okay.
So it doesn't mean anything.
Well, you'll get a little bit for the time, which probably went up yesterday because the volatility's all spiked yesterday. That way, if the deal goes through, hey, you got your profit plus a little bit of extra there. If it doesn't go through and the stock falls back, you're protected. It's like a hedged position.
Interestingly, both these stocks went up yesterday when the market got clobbered.
Yeah, that's cool. Hey, I hear the music. I'm going to have to take a real quick commercial break, but did you want to hold on or do you want to?
Yeah, if I might.
Sure. Listen to Bill Bullington right here on 1420 The Answer with Melissa R. Curry. We'll be back after these messages. And we're back. Hey, Jerry, you still there?
Hi, Bill. I just wanted to ask you one other question. Sure. Valeant Pharmaceuticals, or Valeant Pharmaceutical, have you started nibbling on that yet or no?
No, I probably won't. There are too many things at risk there. And if you look back to the last time a Clinton held the White House, should a Clinton hold the White House again, they went on a big war against all the pharmaceuticals. People forget that. The pharmaceutical index got crushed under the first Clinton administration, and it took them several years to build that back. So I wouldn't be touching anything there other than what shows up in one of my models. If it shows up in my model, and I own them in the model because it's part of the healthcare sector. But when they drop out of the model, they drop out of my portfolio. So that's how I like that. By the way, I looked up that Qualis for you.
Yeah.
Under Y charts, the price to sales ratio of that is 7.4, which is extremely high. The S&P's average is 2, and the industry average is 4.7. So they're almost, they're like
close to double. Yeah.
Yeah. So that's one of those stocks. Yeah, I just wouldn't touch it. I just can't. It's at a peak valuation. And if things don't stay really, really good for that company, that big sound you hear is the price dropping.
Yeah. So it's not going to take a whole lot to get it to collapse if things don't go through or whatever. And upside is anyone's guess, but it's probably closing in on it now as it is.
Well, it's actually it's kind of at the high end.
Yeah, that's what I'm saying. So okay. Very good. Thanks for your help, Bill.
All right, thanks for calling. Have a good weekend.
You too. Bye.
And I will just plug that workshop again one more time. I started talking about it earlier, and I forgot to talk about the beginning part. So the beginning part, we're actually going to talk about the stocks. So kind of the thing that I just looked at. I just pulled it up on Y charts. I will bring my laptop where I have the Y chart subscription. We can show you kind of how to evaluate. I love Y charts. They're not a sponsor, by the way. At least not yet. I keep working on them, but it's a great product. It has all the tools you need in one place. So you type in a symbol, and it's got a few thousand data points. The data is cleaner than any of the data that I've seen, including my Bloomberg terminal, which costs a lot more money. Now Bloomberg's pretty much accurate, but all databases have some bad data in them. There's not a single database that's perfect that way. But anyway, bottom line is Y Charts is a really good service. They have a retail version. I think it's $40 a month, and that scares a lot of people. I'm going to tell you, if you're going to invest, that is the cheapest tool that you'll get with the quality that you're going to get. For the quality that you get, you will not find a better product. Anyway, so there's my plug for those guys. Yeah, it just makes my job easier. In the first part of that workshop, I'll be using that. And we're going to be looking at stocks to basically give you an idea of what a stock picker who's a value-oriented investor might do, because it's something that has been kind of fun throughout the years. You get to see all the challenges. That's going to start at 6:30, and then we're going to take a little break. The real seminar starts at 7:30. That's where we're going to be talking about momentum, which is kind of the other side of the value-oriented investing, and that'll run for about 45 minutes or so. I am going to bring out a new model for those people that like to follow some of this stuff on their own. And in fact, I'll even publish exactly how to do that model. So I'll just put that out as a little ebook. And my ebooks, by the way, are short. Just the Answers is the series I'm thinking about calling them. Anybody with internet access, you don't even have to have a real laptop. You could get one of those Chromebooks. I saw them for $150 somewhere on the internet the other day. You could set up your stock symbols on Google Finance for free and follow these models I'm about to publish for you. I think it's hilarious that you can do this kind of stuff at home. And so I'm going to be showing that in particular. It's fun. Very similar to my ETF model now that I'm running. In fact, the parameters are almost identical. It's just that the funds are a little bit different. There's a different lineup of funds that go into it. So that's going to start at 6:30 for the portion of that. We'll be talking about the old school style investing, the value stuff. Then at 7:30, the momentum will actually start. That's what we're going to be talking about, that new model. I'm going to be looking at the momentum models that I run through Bullington Capital. And should be a good time. So feel free to go sign up. It's at bullingtoncapital.com. Just click on the seminars tab, and look forward to seeing a lot of you there. And I guess we can get back to one of the topics that Melissa and I were talking about on the way in here. One of the big fears, and this is something I've been reading about in magazines, which you actually reinforced when I was talking to this morning, unbeknownst to you, because this is the first time you're hearing me say this, but in multiple magazine articles, the millennials, the people in your age bracket, have an extremely difficult time trusting people. And so the lack of trust, which I thought was really high my entire career, evidently has gotten to the point where younger people are even less trusting. And I wonder if it's because they're more internet savvy, so they spend more time on the internet. The internet does provide a lot more news than the news channels when I grew up, because I think, when I was your age, there were only like 30 cable channels.
Sure. Yeah.
And 30 was a huge expanse over the big 3 and the little 2. You had 3, 5, and 8, and then you had 43 and 61 in Northeast Ohio. That's all you had. Yeah, if it weren't on one of those channels, it wasn't on. Then you had cable, and everybody thought, wow, oh man, like 30 channels. And now it's there. And the internet had no pictures. Back then you could log on to Case Western Reserve. They had a chat room. That was the early internet of its day.
Yep.
So I'm wondering if that doesn't have an impact, because you see so much. You're inundated with so much more news all the time.
Yeah, it might. Because there is a lot more information out there for sure. Everything's at your fingertips now. You don't even have to go to a library. You can just Google everything, and you do find conflicting information on multiple sites. So it does. You have to just check it and verify. But yeah, I don't know. I don't know why they're less,
not as trusting.
Yeah, I don't know.
Yeah, it's interesting. Because you would think somebody with not as much life experience wouldn't be quite as jaded.
Right. Yeah.
But
it's interesting.
Put it bluntly, but anyway, so I thought that was kind of interesting in getting information that might be bad information. That's something else that it talked about. And I wish I had a better answer for that. The only thing I can say is I used to go around and ask. I would take my own personal polls.
Mm-hmm.
And I tried to be careful not to let the people that I was asking know that I was asking other people the same question. Although it might have worked out to my advantage, because if they knew I was checking on everything they said, they might be more forthright. I don't know. You never know. But so that's one thing that I would suggest, probably your age bracket. Find out what's important to you. Keep asking questions. At some point in time, when you start to see a common theme that comes up, an answer that shows up multiple times, it may mean you're on to something. Okay? And I know that's pretty hard, but very difficult. And just have to say thanks for letting me pick your brain.
Oh, sure.
This past couple of years, I know it probably gets pretty annoying at times.
No.
But yeah. But anyway, you've been listening. I guess we're getting waved off here. We've got about a minute and a half left. If you have heard anything, if you see anything, Melissa puts up this radio show as a podcast. You can go to iTunes.com. It's actually on our website as well, and it goes to YouTube. Is that correct?
Yep, and it's on iHeartRadio too.
Oh, wow. So I forgot about that. Yeah, how does that work again with YouTube?
It's basically just a channel. You can go on and subscribe. It's free. Just click the button, and then you just get reminder emails each week when something's posted or whenever we put something up. So all the radio shows are there, and then any videos that we cut as well.
Oh, that's awesome. We'll have to. I've been saying this for a long time. We do have to start getting some more video out there. So a lot of these concepts they're not that hard, especially with services like Y Charts out there. It's going to be a lot easier, I think, in the future for people, especially if you have someone out there that's trying to show them the shortcuts. Because there's no reason for you to read the millions and millions of pages out there that have been written when only there's probably 250 of them that actually matter. Finding them is pretty difficult, but we'll try to shorten that path for them. But anyway, I think I have less than 60 seconds now. So thanks, everybody, for listening. We're here every Saturday morning from 11 to noon, 1420. We're also broadcast at 12:20, 6 o'clock Sunday evening. And now we're on iHeartRadio and YouTube, as well as iTunes. And thanks to Melissa for putting all that together. So we do have 30 seconds. Is there anything you wanted to add? Just real quick? Nope. That's okay. I hear the music. And we have a good week, everybody. Good luck and good investing.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.